And we're back with H.C. Wainwright's Dr. David Ranson. So, infrastructure, in one of your latest HCWE forecasts, Economy Watches, talk about the trade-off between federal spending and private spending. And data from 1929 shows that actually things decline the following year. Why do you think that is? Just public investment crowds out private? And what other insights from that article do you have for our listeners and watchers at home?
Yes, well, you used the phrase, as you used it, crowding out. It's a very old idea. If the government does something, it crowds the private sector out of that business, and the private sector ceases to do it. And the idea of the government is that it's adding to GDP, but the crowding out part of the story means it's also subtracting from GDP, and you may end up with the same GDP you would otherwise have had if the private sector had done the job in the first place. In practice, you can measure these things. Now, my job, what I do for a living, is to measure this as precisely as possible. Some things can't be measured precisely. This is one that can be measured if you use lots and lots of data. And as you say, we have data going all the way back to 1929. And there's one pretty consistent database that I use that goes back to 1945. What happened during the war is slightly different. So I don't try to generalize too much. I'm looking at peacetime infrastructure and other kinds of federal spending from 1945, that is, to the present. It gives us 70 years of data, which is a lot of data, and enough to be able to measure whether we get a larger GDP from having the government increase its spending or a smaller GDP. And to a first approximation, there's no difference. But if you measure it more carefully and precisely, you find you get less GDP, slightly less, than you would have if the private sector had been doing the job in the first place.
And so what asset classes do you like now, given your background in economics? The other thing I wanted to say, a couple days ago, an article by Market Watch, gold futures fall to their lowest settlement in about 6 months. Is that a bad sign for gold? Or positive?
No, that's a good sign. And I was going to tell a little bit more of the story about the futures gold price. In the first few months of this year, the futures gold price was rising quite a lot. In fact, about 20%, just about the right amount to explain how much inflation we got. That was until midsummer. And since midsummer, it's paused, stabilized, and even come back a bit. I can't explain why. I can't explain why it rose in the first place. All of these things have to do with public confidence in the monetary system. I can't see any other explanation.
Well, the decline.
Why public confidence?
May I add something due to the decline? It seems we had a washout in the Bitcoin market. Bitcoin is a contra gold, sort of a digital gold. People were losing faith in Bitcoin over the summer. It seems to have regained its luster in the eyes of some. It's back to like the 40,000 mark. So maybe that, obviously we don't have a lot of data on gold versus Bitcoin because Bitcoin's a relatively new asset class, last, 11, 12 years. But it seems that as Bitcoin was rising, maybe it was crowding out some of the investment that would have gone to gold. I don't know. Maybe that's my take. What do you think about that?
Well, I think gold and Bitcoin move in parallel more than they move against each other. But to be honest, I haven't done the work that I need to do to say anything confidently about Bitcoin. As you say, the history is only 11 or 12 years. That's nowhere near the kind of histories that I need to do most of the work that I do.
No, but here's my thought.
It's only a matter of time, though.
If you were into Bitcoin, you were into gold 12 years ago. You were into a hedge against Fed money printing, all that stuff, government spending run amok. It attracts the same type of person. So
yeah, I think it does.
So I know a lot of Bitcoiners who say, well, I'd rather have digital gold because I could take my digital gold on my stick and flee the country if I need to, or they could, whatever. They could have more anonymity. They don't have to like ship it in trucks and pay people to store it. And so there are a lot of former gold bugs who are now Bitcoiners. So that's what I mean. Like the same dollar is now being split.
Yeah, I understand.
So as Bitcoin kind of fell, gold was rising a little bit. And then as Bitcoin started to regain its hold again, gold came down. Maybe that would explain it. But long term, you're bullish on gold.
Yes, I think the present monetary system, based on what they call fiat currency, is inherently unstable. And it's only a matter of time before people lose even more confidence in it. And things like gold and Bitcoin and many other alternative monies will slowly take over instead. But these Bitcoin and other monies like Bitcoin are technically very difficult to understand. And that's holding them back, I think, initially. Everybody understands gold, but gold is not easy. Of course, it's a very valuable thing. You can't store it in your house. You get burglars the next night. So nothing is perfect.
No, exactly. And what other asset classes do you like for this time period that we're in? We talked last time about your STAR portfolio. Any opportunities you see upon the investing horizon?
Yes, I think one of the major things that's happened over the past year is a big improvement, a resurgence of business confidence and a fall in business or economic anxiety. And we can measure this in the bond market. One of the best measures of this would be what they call credit spreads, which is when you compare one junk bond or one low-grade bond with another one that is slightly different in quality, and the difference in the interest rates tells you how much anxiety is driving them apart. And all of this has changed quite a lot since the depth of the pandemic scare. And so we have much better business tolerance for risk today than we had a year ago. And that improvement in business tolerance means that a lot of capital will stop sitting in safe havens and go into risky investments. And if we're in an inflationary situation at the same time, then what the asset that benefits in both respects would be what's called a real asset, such as commodities are real assets, and real estate is a real asset. And there are many other assets that behave, they may not be real in the same sense, but they behave as if they were real. That includes things like variable rate bonds and also the deepest discounted junk bonds. And quite a lot of other more exotic instruments. These are the asset class that I think benefits most from the current scenario.
And do you like treasuries right now or not really?
No, the Treasury is on the other side of a seesaw. As capital is moving away from safe havens towards risky assets, it's pulling itself out of treasuries, which are one of the major safe havens that we rely on. So this means that treasury rates will have to rise, treasury prices will have to fall.
So do you, so would that would then be good for stocks as well? So you like equities?
I think I'm pretty neutral about equities. I think equities over a long period of time will reflect the growth of the economy. I'm not terribly optimistic about the growth of the economy. We've had some very high growth rates this year, but they're not continuing. They've already slowed down dramatically. We're running at about 1.5% growth currently in the latest data, and I'm very interested in what the latest figures tend to show. And that implies a pretty flat stock market if you don't look at any other factors. One of the factors you might add to that would be inflation, which would hurt the stock market even more.
Wonderful. So we'll be back with Dr. David Ranson. So folks, give us a call, 888-988-JOSH.
The preceding program was sponsored by the Jelensky Advisory Group. Any awards, rankings, or recognition by unaffiliated third parties or publications, including 5-Star Wealth Manager, Advisory of the Year finalist by Senior Market Advisor, and Top of the $1 Million Roundtable, are in no way indicative of the advisor's future performance or any individual client's investment success. No award, ranking, or recognition should be construed as a current or past endorsement of Josh Jelinski or Wealth Quarterback LLC. Information regarding specific awards, rankings, or recognitions is available on the Wealth Quarterback website at www.jelinski.org. All investment strategies have the potential for profit or loss. Investment strategies such as asset allocation, diversification, or rebalancing do not assure or guarantee better performance and cannot eliminate the risk of investment losses. There are no guarantees that a portfolio employing these or any other strategy will outperform a portfolio that does not engage in such strategies. This broadcast should not be construed by any client or prospective client as a solicitation to effect or attempt to effect transactions in securities or the rendering of personalized investment advice. Due to various factors, including changing market conditions, the information discussed in this broadcast may no longer be reflective of current positions or recommendations. While information presented is believed to be factual and up to date, Josh Jelinski and Wealth Quarterback do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. The tax and estate planning information discussed is general in nature, is provided for informational purposes only, and should not be construed as legal or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Advisory services offered through Wealth Quarterback LLC.